Well, amid all the uncertainty around trade and the economy, our guest today has just concluded a big review of company capital expenditure plans. Joining us now to discuss the big takeaways is Terence Chung. He's Vice President and Director for Portfolio Research with TD Asset Management. Terence, welcome to the show.
Thanks, Anthony. Appreciate it.
All right, this is your first time on the show. Why don't you start with a brief overview of your coverage area?
Yeah, so I cover chemical companies and previously covered industrial companies, and in a previous life covered energy companies. So a lot of cyclical companies and exposure in my background.
All right, now I mentioned at the top of the show that you've just completed this big review of the company spending plans. Why don't you walk us through that?
Yeah, for sure. So the reason, maybe I'll just start from the top. The reason why we do this is every year around this time, companies tend to provide an outlook for capital spending plans, and for the coming year, and sometimes for even outer years. And the reason why this is important to us is these capital expenditures flow through into the sales and revenue lines for many of the industrial and even some of the chemical companies that I would look at. And so that's kind of the main genesis of this. The secondary reason why we want to do this is over time, there's a lot of these projects that are longer cycle in nature, meaning that they can't just turn on or turn off at the blink of a headline, so to speak. And so this helps us and enables us to look through the noise and kind of see which companies are still seeing good order growth and good, I guess in a sense, like capital flow through into sales and revenue lines and ultimately into earnings. And it kind of keeps us focused on the fundamentals.
Okay, so as you look through all the noise, again, for the longer term, what markets right now are looking interesting to you? And are there any areas that look more challenged?
So definitely the most interesting areas, I'll give you three. One of the, as you can imagine, the aerospace sector, and that sector tends to be very long lead time in nature. And so when I look at, let's take passenger airlines, even though near term there could be challenges around travel volumes and bookings, but longer term, because it takes a long time to order a jet or order a plane and get in line with some of the, with the Boeing and Airbuses of the world to take delivery, a lot of the times you don't see, too often cancellations for these things that take years to get on board. So that's one area that I still think is quite positive. Another area would be the utilities sector. So whether it's electrical utilities or multi-utilities, some of the projects that go on here, they go on for years, whether it's grid upgrades, generation, transmission, distribution, all of these things take time, and they're not necessarily turned off at a blink of an eye. And so those are a couple areas that I find that are still quite positive. And then the final area, which I think everyone is quite aware of, it would be hyperscaler capex. And so we've seen that area grow significantly. I think it was like over 50% in 2024, and projected to be about over 30% this year. And as we look out into 2026, still very, very solid growth numbers out of the hyperscalers. So now in terms of areas that are more challenged, covering commodities, we definitely see challenges around oil and gas. Oil and gas capital expenditures are expected to likely stay flat to down. And then as we get into the more extremes around some of the chemical names, the commodity chemicals and specialty chemicals, in some cases we even see double-digit declines in their spending plans, tied to some of the uncertainty, which we'll probably talk about afterwards. And then the other area that's a little more nuanced and slightly mixed would be in autos, where in autos we see the traditional automakers really pulling back. And that's offset a little bit by some of the EV automakers, so electric vehicle automakers across the world, a lot of them in China where they're still moving forward with spending.
Okay, now given all the noise around trade and tariffs, what are the key takeaways from your work?
So the key takeaways, I would say, there's really two. The first is, as I mentioned at the beginning, where we want to look past some of the noise and really focus on the fundamentals. So even though tariff headlines come out seemingly on a weekly basis, the longer cycle projects, they keep going on, and we really want to focus on this and kind of avoid some of the noise and really just kind of take a look at what's actually happening on the ground. So that's kind of number one. And number two, I think the exercise really helps us see some of the uncertainty that is coming out of these headlines. So when we think about, once again, when tariff noises, trade noises, geopolitical uncertainty, these headlines come out, you do see at the margin, like I mentioned, some of the chemical companies paring back spending, and that's usually going to be a negative.
Okay, so now when we dig beneath the surface, go through looking through the sectors, what are some examples of companies from your work that you might highlight as being interesting for investors to consider?
So the first company example that I would provide is this U.S. company called Quanta Services. So Quanta Services is an engineering and construction company, but I kind of view them as a solutions provider. And where their end markets lie are generally in the utilities, utility sector, some renewable, some exposure into the renewable sector. But what makes this company so interesting is because they have exposure to this consistent grid upgrade, electrical equipment build out. They basically provide a lot of the labor force and some of the even some of the equipment to the utility customers. They have this very, very solid backlog of work ahead of them. And once again, if we're able to look past the noise, that's been a stock where we've seen that growth from this end market over the last five plus years. So that's one example. Another example I will give is, this is more in the chemical sector, where if we want to think about defensiveness, and I said at the margin, we do see areas where there is capital pullback. We want to be positioned in a company where, or in companies where the revenue lines are more defensive in nature, where some of the revenues can be take or pay. And what I mean by that is they're contracted, and customers have to pay whether or not volumes go through. And the example here of this company would be Linde, which is an industrial gas company, and they provide gas inputs to basically every industry that you can think of, from food and beverage all the way to oil and gas. So those would be two examples that I would think of. Yeah.